Hi guys, welcome back to my channel. Kelvin here. So in Singapore, whenever you want to open a trading account, you will need to do a customer account review. Welcome to Singapore, where you need to satisfy at least one of the following three criteria. You either need to have an educational qualification that's related to finance, or you need to have a minimum 3 years of working experience in finance related field, or you need to have made at least 6 transactions in listed specified investment products. If you don't fulfill any of these criteria, you will need to take the SGX SIP online education module before you can open a trading account. And seeing that there's more and more young investors nowadays, it could mean that you have been training to invest since you guys were 6 years old, or you guys have lied in the customer account review. And it's not good to lie, This guy says it the best.
That would be terrible and unethical, and you should never ever do it.
Then follow up with,
I would never ever use sarcasm. Semicolon, close parenthesis.
So if you decide to be truthful, good for you. You will end up having to take the SGX test. And if you are taking the test, it's better to fully understand what it's trying to teach you rather than just trying to pass the test and immediately go and buy meme stocks. So in this video, I will go through all of the questions, then explain the answers to you so that you can understand a little better. But before I start, I would greatly appreciate it if you can help to tap the like button, because it will help out with the channel. In return, I will show you a raccoon cycling on a bicycle. Alright, let's start right now. Question 1. There's an ABC ETF that tracks index SYZ. SYZ has went up by 10%. So, which is the correct answer? Okay, let's look at a real life example. This is ROBOAD, which tracks S&P 500 index. If you look at the returns, you will notice that it has market price and net asset value. During these 10 years, the S&P 500 index gave 15.43% annualized returns. Meanwhile, the market price of the ETF went up by 15.38% and the NAV of the ETF went up by 15.39%. So it seems like the market price and NAV both track the index, right? Well, yes, but no. That's the difference. The ETF market price is the price where the ETF can be bought or sold during trading hours, while NAV is the fund's underlying assets at the end of the trading day. So this means for the entire day, the NAV doesn't change. But once the market closes, the NAV will only be updated. So the answer is ABC ETF is traded at market price and will provide returns very similar to SYZ index before the fees. Question 2. An ETF buys all the stocks included in the index using the corresponding index weights. So this one is quite easy. It buys real stock, so it's cash-based ETF. For example, ROBOAD, where the holdings are real stocks. On the other hand, synthetic ETF invests into derivatives and swaps. One example is SGX, ProShares Ultra Short S&P 500, where it 2x inverse S&P 500. Basically, it goes the opposite direction of the S&P 500. If S&P 500 go up, this ETF will go down. But if S&P 500 go down, this ETF goes up. One way you can achieve this is by using derivatives. So SGX is a synthetic ETF. Pro tip, an easy way to tell is by checking in fund supermarkets. SGX synthetic, ROBOAD physical. Question 3. Which is false about synthetic ETFs? The answer is the first one. Synthetic ETF is not immune to default risk of counterparty. Maybe you are blur and be like, who is this counterparty? The counterparty is usually an investment bank, so that they can ensure that the benchmark return is paid to the fund. But if the bank close shop, then the ETF may suffer losses. Question 4. Which best describes the tracking area of an ETF? Okay, this is quite straightforward also. So while an ETF tracks the performance of an index, it can't exactly replicate the performance of the index. It can be caused by a few reasons. First, diversification rules, because some ETFs cannot hold more than 25% in any stock. So the holdings will be a bit different. Second, management and trading fees. So because of the fees, the returns will be a bit different. Third, securities lending. While fund managers can lend the stock to other people to short, they still own the stock and can receive dividends. So this can create some difference in returns. But it's not a big issue because the tracking error is super duper small. For example, there's 2 ETFs tracking the STI for Spider STI ETF. The tracking error is just 0.18%, while for Nico M is 0.15%. Question 5. Which of the following is true about exchange traded notes? Okay, if you blur and don't know what's ETN, don't worry, it's likely that you will never ever trade ETN in your whole life. But in short, ETN is just unsecured debt securities that track an index. It's similar to bonds but do not pay interest. One thing to note is that ETN has a maturity date. Once it matures, the financial institutions will pay back the returns. One example is VXS, where it tracks S&P 500 Weeks Index. VXS has already matured in 2019 and is now replaced with VXSP, which will mature in 30 years' time. So back to the question. ETF is tracking an index with tracking error. This is true. ETN will most likely have an expiry date. This is true also because it's debt securities, so it will have an expiry date. ETN is a debt security issued by the bank or financial institutions, and investors are exposed to the credit risk of the issuer. So this is true also. So the answer is all of the above. Question 6. What's the maximum loss for future contract? Okay, first up, if you don't know what's future contracts, basically it's just a contract that lets you buy something at a fixed price in the future. The usual future contracts are stuff like oil and gold, but do you want to buy oil and gold? No, right? What are you going to do with that anyways? That's why people only try to use futures for trading to try to hoard big. I will use oil futures as example. One future contract of oil is 1,000 barrels. If the contract is $55, it doesn't mean that you have to come up with 55k. That will be too expensive. Ain't nobody got money for that. Instead, you only need to come up with an initial margin. And since you are trading on margin, your gains and losses will be amplified. So back to the question. Because futures have margin, your maximum loss can be more than the initial margin. Question 7. Michael wants to buy a futures contract with an underlying asset worth 20k. Initial margin 3k. Maintenance margin 2k. When will there be a margin call? Okay, this is quite easy. You are starting with 3k and you need to maintain at least 2k. As long as the future dropped by more than 1k, you will have a margin call. The correct answer was drop to 15k or drop by 5k. Question 8. For an European style call warrant expiring on 10 December, which is true? Okay, warrants are very similar to options. The main difference is that while an option is traded between investors, a warrant is issued by the company to an investor. There are two kinds of warrants or options, American style and European style. For American style, you can exercise the option anytime you want, and for European style, you can only exercise on the expiry date. So back to the question. First, warrant is the right to buy the asset at a predetermined specific price. True. Second, the warrant will not be tradable after 10 December. True, because it expires on 10 December. Third, warrant can only be exercised on 10 December. True, because it's a European style warrant. So the answer is all of the above. Question 9. ABC share price is now $16. The call warrant has a strike price of $14, which is true. Okay, if you are new to options or warrants, it's super duper hard to remember call, put, in the money and stuff like that. So let me show you what I usually do. This is Tiger Broker's app, and this is the options for Tesla. On the left, you have call options, and on the right, put options. When the option is in the money, it will have a colored background. When the option is out of the money, it's just a black background. So for example, right now, Tesla is $922. Any call option that's below 922 are all in the money, because the purpose of call options is to buy stock below the current stock price. Example, it's better to buy Tesla at $905 instead of $922, right? On the other hand, the put option that's above 922 are all in the money, because the purpose of put option is to sell the stock above the current stock price. Example, it's better to sell Tesla at $940 instead of $922, right? Back to the question. The call warrant, which has a strike of $14, is below $16, so it's now in the money. Question 10. The price of the put warrant will decrease closer to expiration date. So it's not just put, it's call warrants also, because all options and warrants will decay over time. If the price of the underlying asset decreases, the price of the call warrant will decrease. This is because when the stock goes down, the call option has lesser value now. Finally, if implied volatility increases, the price of the warrant will increase. This is because when IB goes up, it means that no one knows where the stock will go. So the option price will usually go up. Question 11. Lucas is confident that his $20 stock will drop to $12 in 3 months' time, and he wants to use warrants to profit. One look and you know this Lucas is an ape from Wall Street bets. Anyway, if you are betting that the stock will drop, you will use put, because put let you sell the stock at a higher price, yeah? So the answer is warrant C, put warrant. Question 12. Lucas the ape has a put warrant with exercise price of $18 and a 1-to-1 conversion ratio. The put warrant is 50 cents and the stock dropped from $20 to $12. What's his net gain? Okay, this is just primary school math. The put warrant lets you sell at $18, so you take 18 minus 12. That's your profit. Then don't forget to minus off the 50 cents put warrant price to get the net gain, which is $5.50. Question 13. A put warrant has an exercise price of $18 and the conversion ratio of 5 warrants to 1 stock. Lucas the ape buys 5 put warrants at a price of 20 cents per warrant. Now, the stock has dropped to $12. What is his net gain? Again, this is quite easy. You take 18 minus 12, you earn $6. But because one stock is 5 warrants, you divide $6 by 5. Then minus off the 20 cents buying price to get the profits, which is $1 per warrant. Question 14. Which is true? Option issued by exchange, while structured warrant is issued by financial institution. This is true. Investors can write or sell an option while you cannot write warrants. This is true also, because warrants are issued by financial institution. So both statements are true. Question 15. The warrant has this name, which is true. Okay, this is the naming convention of a warrant. This is the asset name who issued this warrant, whether it's European or American style, whether it's a call warrant or put warrant, the expiry date of the warrant, the format is year, month and day, then finally the warrant's ID. Back to the question. This warrant's underlying asset is DBS, is issued by AA, European style, call warrant. It expires on 2018, December 20th. So this is the answer. Question 16. Next, Grace, a savvy trader, also from Wall Street Bets, bought a 7S long ABC index daily leverage certificate and invested 1K. The index went up by 2%. Okay, first up, daily leverage certificate lets you amplify your gains and losses. So with 5S leverage, if the stock just goes up by 2%, your gain is already 10%. Or if it drops 2%, your losses is amplified to 10%. So it's super duper dangerous stuff, yeah. If you look at the question, the long here means she will profit if the stock goes up. On the other hand, short means she will profit if the stock goes down. So again, this is just simple math. She invested 1K, the leverage is 7x, and the index went up by 2%. And because it's long, her investment will increase by $140. Question 17. If an asset goes up by 1% every day over 3 days with a 5x long DLC, what's the total return? Okay, here's how to calculate it. Let's say I invested $100. The asset gains 1%, but there's a 5x leverage, so it's 5% gain. On day 1, I have $105. Day 2, 5% gain. Day 3, 5% gain again. In the end, I will have $115.76. So I've gained a total of 15.76%. The closest answer is 15.8%. Question 18. Due to compounding, what will happen when the market is moving sideways? Okay, even though the market is moving sideways with leveraged products, you will actually end up with a lower return. Check this out. This is an ETF, but it has the same effect, yeah? If you see the blue line, it is moving sideways. But the green line and red line are leveraged ETFs. It will slowly go down in a sideways market. Here's why. Let's say the stock goes from 100 to 110, then back to 100. Without leverage, it's 10%, then negative 9.09%, and so on. But if the ETF is leveraged, the percentage goes up by 30%, go down by negative 27%. Over time, the ETF will end up dropping more and more. This is also the reason why, even though I like Tesla, I don't invest in 3S Tesla. Because if Tesla goes sideways or goes down, I will end up losing money. Question 19. If the underlying asset drops by 12%, which will trigger the airbag? Okay, for short, if the stock drops, they will hot big and it won't trigger the airbag. Only Lucas' airbag will be triggered because he long and has a trigger level of 10%. Question 20. Michelle thinks that the market is negative. What should she invest in? Obviously, the answer is just to buy and hold and continue dollar cost average like any good investor. But we don't have the answer here. So we will just have to choose something that goes up when the market goes down. It's either a put option, warrant, or short invest products. So those were all the 20 questions. That wasn't so hard, right? Hopefully, after this, you understand a little more about investing, yeah? Anyway, like always, like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.